Now let's discuss different statistical methods that we can use to set threshold values in scenarios for transaction monitoring. In this lecture, we'll discuss two of such approach. One is standard deviation, another is Z score. So before we start discussing those tools, let's look at our data. Here we are going to monitor transaction of specific customer segment, that is high net worth customer, which are usually classified as a high risk as their source of income is not clear. Here here we have calculated here for this data we have calculated mean value and standard deviation. So the mean explains average value of transaction. So the average value of this annual transaction amount is equal to 101 dollars, and standard deviation is 17.77. Standard deviation explains variation in data. It tells you how individual transaction differs from average. If the standard deviation is low, it means that most of numbers are close to the average. However, if the standard deviation is high, it means that numbers are spread out over a range. Means variation is high. Now let's look at this graph. This shows, let's look at this graph. This is a mean, and from here to here is a first standard deviation from the mean, which includes about 60% of total values or data. From here to here is a second standard deviation, which includes about 95% of all values. Similarly, from here to here is a third standard deviation, which includes 99.7% of all values. By calculating third standard deviation from the mean, we can identify upper limit beyond which transactions are significantly large. For example, if the mean transaction value is around here, mean value of the transaction, annual transaction is 101, and we can safely assume that third standard deviation is around $50. So the upper limit is $151, right? And this would be considered unusually large and needs to be investigated. Since standard deviation includes 99% of total values, by focusing on transaction beyond the third standard deviation, which represent the top 0.3% of the values, we can set threshold for monitoring large transaction. So from this example, transaction exceeding $151 would be flagged for further review as they are potentially large transaction. Hence, standard deviation allows financial institution to efficiently monitor transaction within specific customer segment and identify outliers that may require further investigation, such as potential instances of fraud or money laundering. Now let's look at our Z score. This is another statistical tool that we have to create threshold values for our scenarios. Now let's explain what is Z score. Z score is also known as the standard score, is a statistical measure that indicates how many standard deviation a data point is from the mean of a dataset. It is used to standardize data and compare individual data points to a standard normal distribution. In the context of monitoring transaction for suspicious activity, the Z score helps identify transactions that deviate significantly from the average, which could indicate potential anomalies or risks. From our previous discussion, we have identified that upper limit of the transaction is 151 USD dollars and its Z score comes around to be 2.8 or around 3. So we can assume that any transaction with Z score is greater than 3 should be considered as a high risk and should be investigated. So hence we can set threshold value as a 3. Hence understanding the characteristics of the client segment is crucial. In some cases, suspicious activity may be concentrated in a smaller segment rather than large subset of clients. For example, if it is determined that suspicious activity is more likely to occur within the top 20% of account rather than just top 0.3%, the threshold for flagging transaction should be adjusted accordingly. Therefore, for this, we need to perform above and below the line testing, which is a very important concept that we will be discussing in our upcoming lectures.